JP Morgan just dropped a number that should worry every AI investor. 60% of next year's data center capacity hasn't even broken ground yet. I'm Alex Carter. Welcome back to Wealth Signal. Everyone's been asking the same question this week. Is the AI build-out already priced in, or is it just getting started? A new JP Morgan report just answered that question with hard numbers, and the answer might surprise you. I went through this report line by line, and what stood out wasn't the hyperscalers everyone's already watching, Microsoft, Amazon, Meta. It's the companies actually building the infrastructure behind them. If you're serious about understanding where the real money is flowing in this AI story, not just the headline names, hit that subscribe button before we get into this. Today I'm breaking down 3 companies sitting right in the middle of this build-out gap. One of them is up over 169% in the past year alone, and I'll tell you exactly why at the end, because the reason isn't what you'd expect. Here's what the report actually said. 60% of the planned data center capacity for 2027 hasn't broken ground yet. Another 7% that's already under construction is running into delays, supply chain bottlenecks, permitting issues, and a problem getting bigger every quarter. Where's the energy going to come from? The hyperscalers have already committed the cash. Microsoft, Amazon, Meta confirmed in their last earnings reports they're not slowing down. They're increasing CapEx spend. But the companies actually building these sites, the shovels, not the checkbooks, can't keep up with that demand. And that gap between the money that's been promised and the infrastructure that's actually been built is exactly where the opportunity is for investors. Not in the names everyone already owns, in the companies closing that gap. Eaton's been around for over a century, making power equipment most people never think twice about. Today, they make the electrical guts that connect the power grid to every single server rack inside a data center. Eaton? Really? That old-school industrial name? Yes, exactly that one. They're not just an electrical equipment company anymore. They're becoming one of the backbones of the entire AI build-out. Revenue came in at $7.45 billion last quarter, up from $6.38 billion the year before. Adjusted earnings hit $2.81 per share. The stock is up about 32% year-to-date, beating the infrastructure ETF, which is up around 22%. And inside their data center segment specifically, orders jumped 240% year-over-year. Now, here's what concerns me. The stock has struggled to break above $400. It touched $435 back in May and hasn't pushed cleanly past it since. Investors seem to want one more signal before they're willing to chase it higher. Imagine you'd bought Eaton purely as a boring industrial play a year ago, with no idea the data center segment was about to explode. You're not just holding a stable old company anymore. You're holding a stock with a second growth engine that's just getting started, backed by a fresh acquisition in liquid cooling and a direct collaboration with NVIDIA on next-gen AI factory platforms. Eaton handles the power. But getting that power to the site in the first place is a completely different job, and that's where our next company comes in. Drop a comment below and tell me, Eaton or one of the next 2 we're about to cover? Which one would you put your money on? If Eaton makes the parts that go inside a data center, Quanta Services is the company that does the physical work of getting electricity into the site in the first place, running the lines, building the substations, connecting the grid. At their 2026 Investor Day, Quanta outlined a $2.4 trillion addressable market through 2030 for a company that did about $32 billion in revenue last year. Last quarter, revenue jumped from $6.23 billion to $7.87 billion. Earnings per share went from $1.78 to $2.68. Their backlog is sitting at over $44 billion, up 27.5% year-over-year. The challenge here is the stock is trading within about 5% of the average analyst price target. Normally, that would worry me, But analysts aren't pricing in fundamentals that haven't shown up yet. They're chasing fundamentals the company has already delivered. That's a very different kind of risk. Institutions are buying more than 50% more than they're selling right now. That's the smart money telling you where it wants to be positioned. This isn't a screaming bargain, but it's a name worth watching closely on any pullback. Now let's shift gears completely. Once the power's actually flowing into a data center, there's a new problem: keeping it from melting itself. That's where our third stock comes in. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Every GPU running inside these data centers generates massive heat, running 24/7. Vertiv is the company that keeps it all from cooking itself through liquid cooling systems that have become the go-to solution for the entire industry. For years, the loudest criticism of AI data centers was water, that all this cooling was draining resources the planet can't spare. Now, in a matter of a few years, liquid cooling technology is flipping that story, making these sites dramatically more efficient instead of more wasteful. The stock is up over 100% year-to-date and up 169% over the past 12 months. The company just raised its full-year guidance to between $13.5 and $14 billion in net sales. They've also been actively acquiring, picking up strategic thermal labs and ThermoKey, expanding from chip-level cooling all the way up to facility-scale heat rejection. Here's what concerns me. After a run like this, some analysts have already moved to hold or sell ratings, and the stock hasn't had a meaningful pullback in months. Anytime a stock runs this hard this fast, trimming a position isn't a bad idea. It's risk management, not a loss of conviction. The growth story isn't over. Some analysts still have price targets above $500. But this is a name to watch for a real pullback before adding, not one to chase at the current price. If I had to rank these three, I'd put Quanta third. Not because the fundamentals are weak, they're actually excellent, but because the stock is already trading close to where analysts think it's worth. Second is Eaton. Strong growth, but it needs to clear that $400 resistance before I'd call it a clean breakout. And first, the one I teased at the start, is Vertiv. Not just because of the 169% run, because it's solving the one problem that could actually slow this entire AI build-out down: water and heat. That's why I'd watch it closest, even after a pullback. None of these three are the flashy 100-bagger names everyone's chasing. They're the companies making sure the AI build-out can physically happen at all. Sometimes the best opportunity isn't the loudest one in the room. This is my analysis based on research, not a recommendation. Your situation is different from mine. Always do your own homework before putting any money into the market. If this breakdown helped you see the AI story differently, smash that like button. Subscribe with notifications on. I'm covering this build-out gap every week. And drop a comment. Out of Eaton, Quanta, and Vertiv, which one are you watching closest? And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.